We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Pento from Pento Portfolio Strategies. Michael, thanks for joining me today. How are you?
My pleasure, Tom.
So, Michael, when we consider the current economic numbers, it seems that the Fed's hands are really tied here with, let's say, needing to raise rates to fight inflation that is projected to rise. And on the other hand, we have this kind of looming recession and record layoffs happening, which would beg for, you would think, lower rates. So how are these two different sides of the scale balancing out at the moment?
Great question to start. Well, first of all, I would think that if you just came from Mars and landed on Earth and didn't know anything about anything except, the Fed's charters for stable prices, which means stable means zero. So it doesn't mean 2% inflation, it means zero. And he said, well, how long has the Fed been above 2%? Well, they've been above 2% for 4 years. Well, when do they think they're going to get back to around 2%? Well, 6 years. Okay, so how fast are they raising interest rates? And especially in light of tariffs, which are taxes, which raise prices. I know it's a one-time shock. It's not inflation, but it does raise prices to a consumer who's been inflation ravaged, inflation decimated. So I would say, how quickly are you going to raise interest rates? The Martian would be surprised to figure out and to discover, well, the Fed has been cutting interest rates. They cut interest rates already 100 basis points, and they're going to cut rates again. And the reason is clear is because they are worried about banks' balance sheets. They're worried about the collapsing or the coming collapse of the housing market, which is, to me, it's blatantly obvious that home prices are going to plunge. They're worried about asset prices as far as equities are concerned. They're worried about credit, and they're looking for reasons to get interest rates down. And they have to ignore inflation to do that.
Exactly. It seems that, we're really, as you recently wrote, the Fed's hands are tied in this Gordian knot, right? They have these counteracting data that really they're pushing on the Fed from both sides. But, with Trump's implementation of these tariffs, do you think, or, at least the threat of these tariffs kind of back and forth, this uncertainty ending up affecting this balance, do they only exacerbate this current condition?
Well, first of all, so you say they're getting pulled from both sides, and you're correct. But so you ask, if I was to ask, I would have many questions for the Fed if I was ever asked to go into an FOMC meeting, a press conference. But I would say, well, if you have a dual mandate, which is stable prices and full employment. By the way, employment has zero to do with inflation. Zero. Inflation is about the market losing confidence in the purchasing power of a fiat currency. That's where inflation comes from. So if you have a very high unemployment rate, but also very high rates of inflation, what would win? Or what would you do? I'm sorry. What's that? So if you have a very slow economy, so you have stagflation, high inflation, a slow economy, what would you do? And I think the Fed would have to opt for the slow economy. They're there to bail out banks' balance sheets. That's what they really care about, and to make sure that the government can finance its debt at a reasonably low interest rate. That's why they actually grew their balance sheet from $700 billion to over $9 trillion, taking on all of this debt just to make sure the government could have successful treasury auctions. Mm-hmm. They are an ignorant, blind buyer, price agnostic buyer of the government debt. So what was the second part of your question again? I wanted to just make sure I got that clear. But what was your question?
Do the tariffs only exacerbate these current
conditions? Well, yeah, of course, the tariffs only exacerbate the condition. It's a one-time shock to the level of prices. As I said, inflation is about the market's confidence in a fiat currency's purchasing power. And that usually gets destroyed by massive monetization of government debt. The history is replete with examples of that. So we don't have to guess where inflation comes from. It's not a Phillips curve phenomenon. It is about the destruction of a fiat currency's purchasing power. And of course, tariffs, and I'd love for you to explain to me what the tariff situation is. It's dizzying. But what you do know, and we talked about this in the pre-interview a little bit, I don't have to worry about calculating the exact average tariff rate for every single country to come out with my money management philosophy. Is it 20%? Is it 10%? Is it 20% just on China? Is it 145% on China? Does it exclude this carve out and that carve? I care about when credit spreads start to rise and financial conditions begin to tighten. That's when I, as an active money manager, are not going to tell you, my client, well, don't you know that the government put is in full effect and we got a Trump put, we've got a Powell put. And even if the market does drop, it always comes back. It always comes back. It only takes 6 years for a 50% drop to bounce back 100% to break back to even, unless, of course, you live in Japan or you live in China, where you're still waiting. I mean, China, the Shanghai index, I think, is down 45% from where it was in 2008. And of course, Japan is lower than it was in 1989, or just about the same level. So no, the market doesn't always come back. And if you are in your, approaching retirement years, or if you're in retirement, I don't think you find the ability to placate anybody by saying, well, I know you're down half of your retirement savings, sir or ma'am, but if you wait 6 years, it might come back this time. Wait a second. Maybe it won't come back this time, because this time around, the normal amelioration process, which is lower interest rates. See, the Fed cuts interest rates supposedly proactively, but they're always late to the game. The Fed usually arrives on time to cut interest rates to 1% or 0%. The market still drops 50%, but that's still enough to reliquefy the banking system. And of course, when you cut rates that low and people fly into safety of the bond market, long end rates come down too, and that tends to reliquefy the banking system and reinflates asset prices and is a buffer for the economy. But let me see, this time around, interest rates are actually rising in this chaos. In fact, they are a predominant cause of the chaos. So maybe the market isn't going to come back after 6 years. So I wouldn't take any solace in that mantra.
Well, Michael, exactly as you're pointing out, because of rising interest rates, and again, this idea that we've kind of chewed through a little bit of these countervailing forces on the Fed, will the Fed be slower to react to a crash than it otherwise would be?
Well, by definition, they have to be, because if the Fed is under Powell is, I think they have a cutting bias, as I mentioned at the start of the interview. But are they really going to be in a rush to ex ante slash interest rates in front of tariffs and in front of an environment where inflation is still way above its target? No, I think they're going to have to see unequivocal evidence that inflation is heading to 2%, inclusive of the tariffs, to give them the cover to cut interest rates. But they will wait even longer than usual, which is, as I said before, is too late. If you look in 2001 NASDAQ debacle, March of 2000 to 2003, the S&P still lost 50%, even though the Fed cut rates from 6.25 to 1. And the Fed cut interest rates from 5.25 under Bernanke to 0. But that didn't stop the S&P from losing 50% and the housing market from dropping 32%. But I even think they're going to be later than normal because, as I said, they have a Gordian knot right now. They cannot move proactively. So they'll be later than usual, which means the potential devastation in the market is going to be more profound than usual. And then they will act in arrears. And then when they do act, Tom, the question is, what happens? The most salient question. What happens with long-term interest rates? when the Fed starts cutting interest rates, expanding its balance sheet, returning to ZIRP, going back to QE, Fed's balance sheet goes back to 9 trillion and perhaps way above that into double digits. Is that enough to save the dollar and the bond market from utter chaos and collapse? It's not guaranteed to happen. It's certainly a risk. When you're starting off with $2 trillion deficits, they're going to go to 2.4 if the according to the CBO, 2.4 trillion a year if they pass the extension of the TCJA, the Tax Cuts and Jobs Act. So you're looking at deficits that are absolutely incredible, 6-7% of GDP before the recession starts. During the recession, they're going to go to $6 trillion, which is, about, it's almost, what is it? It's 20% of revenue now, right? So you're talking about, percentage of revenue much higher than that in the case of when we have a recession.
Well, Michael, is the bond market yields have been spiking over the last, let's say, 2 weeks here. Is that also kind of signaling that a recession is coming?
No. I mean, that's the opposite. So in normal times, when a recession comes, yields tend to drop because people sell stocks and run to the safety of the bond market. But this time around, they're not doing that. Foreigners also participate in that function. But this time around, they're doing the opposite. They're selling it. They're selling treasuries and they're buying gold instead. And I can give you some reasons why I think that's happening. Let me do it anyway, in case I know you're a good interviewer. You're going to ask me anyway. So why are treasuries spiking instead of falling? So first of all, you have that insolvency issue that I just talked about. Debt is now 720% of revenue. Deficits are surging, so you have that insolvency issue. So if you look at total assets minus unfunded liabilities, it's a minus sign, definition of insolvency. You have the inflation problem I just talked about, intractable inflation. But adding to that, you see, like when China says, well, should I continue to park my trade surplus, my currency reserves in US dollars when this country hates me? That's the feeling that they get. That's not my opinion of what China thinks of the United States. That's what China is saying about the United States. So does it make any sense to do that? So what China is doing, I believe, is they're selling treasuries. They're not dumping their entire, almost $1 trillion supply of treasuries. So I think it's $750-800 billion of treasuries. And neither is Japan doing that, but I'll get to them in a second. They are the largest holder of U.S. debt. They're just stopping to buy it, and they might be selling on the margin, but prices are set on the margin. So instead of recycling their trade surplus into dollars and into treasuries, they're selling treasuries, selling dollars, and buying gold. That's my opinion. And look, that's the evidence. The deductive evidence is right there. The treasury prices are falling, yields are rising, the dollar is tumbling, and gold is soaring to all-time record highs. You look at Japan too. Japan's interest rates have gone from 22 basis points in the fall of 2022 to 150 basis points today. It's a huge move higher in Japanese government bonds, which usually traditionally offered zero. So their domestic market, the domestic buyers now have an alternative to holding U.S. treasuries. And then, of course, if global trade is collapsing because of tariffs, and it is, then there's just less of a trade surplus in the first place to recycle into our bond market. And then when you add things like these arcane treasury trades on the part of hedge funds, like the basis point trade and the swap spread trade, you can see why treasuries are falling in price and rising in yield instead of the normal function, which is to have yields fall.
So all of that is driving more demand into gold because of this, let's say, possibly dysfunctional or not normally functioning treasury market.
Yeah, well, you have the collapse of the stock market, which is it's just an incipient collapse, insidious and incipient. And then you have the credit market chaos that's happening now, and then you have the real estate market, which is it's just it's hanging on the edge of a cliff here. You have home listings that are up 33% year over year. Mortgage rates are rising along with the bond market. The home price to income ratio is at a record high. Home or affordability is at a record low, and investors are starting to dump their holdings of real estate that have doubled in the last few years. FHA secure loans, which are up 1,000%. See, we don't have ninja loans anymore, Tom. We have FHA secure loans, which are 3.5% down, which is basically nothing on people who are kind of like marginal buyers, and those people have to now pay their mortgages, and they can't pay their mortgages. So there's hundreds of billions of dollars there that's going to come out into default. So we have the real estate crisis 2.0, but it's not in isolation. It's going to come with a bond market, credit market, and an equity market debacle. So yeah, the tariffs have exacerbated and expedited this process. We were heading for a recession anyway. If you look at the falling labor force growth from the border being closed, thankfully, if you look at DOGE efforts to cut government hiring and government spending, those are very helpful in the long run, but short term, they're very disruptive to economic growth. So in the short term, I'm very bearish. If you want to talk about my equity exposure and my positioning, I have a neutral position in equities. We only have low volatility sectors. We are short high vol sectors. We own a tremendous amount of short-term bonds, not long-duration bonds, short-term bonds. And we own gold. And we're sitting here watching our accounts, approach all-time record highs while the market's melting down. Mm-hmm. But that's the benefit, Tom, of having an active manager. 95% of Wall Street are just salespeople, in my opinion, unfortunately. So what they do is they raise assets. They're very good at that. They usually work for some big wirehouse like Morgan Stanley. I work for Morgan Stanley or whatever, Goldman Sachs or whatever. And you say, well, just give your money to me because I have a great firm behind me. What a wonderful team we have. And then most of them just say, okay, let's just try to closet index the S&P 500 with some maybe we'll sprinkle some international exposure in there and we'll buy some bonds as a ballast depending on your age. Right. And then we'll go off to the golf course and raise some more money. That's why you'll hear from the mainstream financial media, buy and hold, and that's what caused this massive bubble to begin with. People just blindly been funding their 401ks, and that goes into the highest cap weighting in the S&P 500, so the Mag 7. And that inculcation of a Fed put and a government put has been there for many, many, many decades, multiple decades now. So they're going to be sitting there and say, hey, you know what? Just don't look. I hear this over and over again from people, my friends who aren't, invested with me or they're just, with other people. They say, I just haven't looked at it. Just don't look at it, and it'll be fine. And then, Tom, I predict in a few quarters from now, when the market's down 30 or 40% and maybe more, potentially, and then they're forced to look at it, and then they call up their plan administrator, stop funding my 401k and change my allocation to bonds, not stocks. And that's when you might see this bond rally occur. But that'll be the time you want to get interested in stocks a little bit. Do the opposite of what this panic, passive, unrelenting flow of money into the stock market goes into reverse.
Mm-hmm. Yeah, I think always being aware of obviously where the market is heading is absolutely useful, but understanding why it's happening is far more important. But Michael, you mentioned this idea of the market being so driven by liquidity. How do the low levels of the TGA and the reverse repo facility have a role to play in this at this time as well?
Huge. So if you look at the excess reserves being parked at the reverse repo facility, they were at one point, the Fed says, I don't want you loaning, I don't want you buying bonds and making loans with these reserves because that will lead to inflation. So I'm going to pay you interest on those reserves. So you park those reserves, excess reserves at the Fed, and those reserves were 2.5 trillion at the high watermark. Well, now they're 88 billion. So the liquidity there, that free money that was used to buy bonds is running out. Mm-hmm. And the reverse repo facility, I just talked about that. So the Treasury General account, that's the account that the Treasury has at the Fed. Well, that's being drained. At one point, that was, I think it was 880 billion at the high watermark. Now it's just a few hundred billion left in that. And then you look at banks tightening lending standards, and if you look at the real level of the real Fed funds rate, so borrowing money actually costs you something for a change instead of being negative or basically zero, almost zero in nominal terms and negative in real terms for most of the past 15 years, mm-hmm. or for most of the time between 2008 and 2023. Negative in real terms. Profound. Sometimes it was negative by like 8%. This is a very unusual period in history. The only other time comparable was in 1974 to 1981, when you had or in 1980, you had 6 years of negative real interest rates. And where did that leave us? With a devastating bout of stagflation, mm-hmm. which I kind of think we're headed for anyway. Eventually.
It seems this combination of, credit, like lending standards tightening and less liquidity, on top of all of the economic indicators like jobs, all of these things, it seems like a horrible, combination altogether. So, Michael, when, again, backing out to be able to understand this from your model, being able to build that model, is that what helps you to be able to navigate a time like this that, as you rightfully pointed out, that we haven't seen very many times before?
Yeah, I wouldn't be able to invest. I have money of my own that I have to invest. So, and I have hundreds of millions of clients' money that I have to invest. So I couldn't do this job, and I couldn't invest my own money with any kind of ability to sleep more than like an hour a night, maybe with one eye on Bloomberg TV open. If I didn't have this model, Tom, I need a model because I want to know the arcane components in the stock market that will inform me of when I need to make a change in the portfolio. Mm-hmm. And that's why I built the model. It's a 20-point model. It's extremely robust. But you see now, consumer sentiment is falling off the table. You see consumer inflation expectations are at an all-time high. And you see this is a situation, the liquidity and the tightening financial conditions and this credit spreads are starting to blow out. And it's happening not when you have total market cap of equities to GDP at 50% or 100% or even 150%. It's 190% of GDP. It's just off the charts. Or if you look at price to sales, it's three times sales instead of 1.5, where it should be historically. And there's many other metrics to look at. The Case-Shiller PE ratio. So this is a very overvalued stock market, perhaps one of the most, if not the most overvalued stock markets. So when you say the average recession brings the S&P down 37%, it's a 34 or 37, it's mid 30% on average. Well, this is not an average recession. You have a triumvirate of asset bubbles that are going to be bursting simultaneously on top of record high asset prices. So no, this is not going to be a 34 or 37% drop It could be much more of the 50% drop that we saw in the last two recessions, ex-COVID.
Mm-hmm.
And it could be, and the NASDAQ dropped 83% in between 2000 and 2003. So I don't think it gets that bad. But I mean, what the Fed's going to have to do to combat this is going to be eye-popping. I mean, forget about just ZIRP and QE. You're talking about another round of helicopter money and the Fed's balance sheet going to well into the double digits. And the effect that's going to have on our bond market and our dollar could be unimaginable. So I'm looking at maybe where there's a time frame where you see prices stabilize just because inflation is just, it's very hard to short a market where inflation is accelerating quickly. I would never do that. Mm-hmm. But in real terms, you're going to get devastated, what you wiped out in your holdings. But you had better know what to own, though. So in a stagflationary scenario, you don't buy the Mag 7. You don't buy utilities. You tend to buy base metals and energy and precious metals. They do the best in that kind of scenario. Mm-hmm. You also should be with an advisor that can short the bond market. But the buy and hold, lull you to sleep portfolio 60-40, that doesn't work when both. 2022 should have hammered the point home that when both stocks and bonds are in a bubble, owning bonds doesn't provide a balance. In fact, it just exacerbates the pain mm-hmm. of declining equity prices.
Michael, you mentioned earlier that this, buy with your eyes closed idea of, let's say, the Mag 7 in particular here. How much of a role do you think this passive investing, only, let's say, pension funds, for example, only buying because these are the stocks that are outperforming the market? How much of a role do you think that played in getting us to this point?
It's huge because S&P is a market cap weighted index, and you have passive investment from 401k plans and pension plans, or retirement funds, insurance companies. They just passively buy the S&P 500. That's what I said in this interview. I said that's what these wirehouses do. They just try to closet index the S&P 500. They might not call it. They might not buy SPY, the ETF, but they'll buy the heaviest weighting, and they just buy the S&P 500. Mm-hmm. And because it's a market cap weighted index, that money continues to concentrate into the highest cap weighted equities, mm-hmm. individual issues. So you get 7 stocks that become like 40% of the S&P 500. And it doesn't happen by osmosis, and it's just blind. It's almost like the Fed buying bonds. It's a price agnostic buyer. Well, so are passive funds. Mm-hmm. You get your paycheck. Your paycheck has a certain percentage allocated to go to your 401k, and the 401k goes into the S&P 500 funds, and those stocks that are highest cap weighted get most of your funds. And all of a sudden, you're several miles over the cliff. The coyotes, floating on air, and then all of a sudden you go, oh my gosh, maybe I do have to look at my 401k, and then all of a sudden they panic, and it's a plunge, and that's what I think is going to happen. Mm-hmm. Hasn't happened yet. It's just the incipient components of it are all coming together. So the fact that we're down 10-15%, it's nothing. We actually have because you have to stay tuned, Tom, don't you know, to every single word that comes out of the administration. And this is not derogative to Donald Trump. I voted for the guy twice, so I'm apolitical. I'm a libertarian. I'm not Democrat or Republican. But you do have to acknowledge that you do have to stay tuned. This is not a plan. This is not a set it and forget it plan. Mm-hmm. So if I just could talk a second about tariffs, I believe it's a very noble effort on the part of the president to try to rebuild the middle class and to rebuild manufacturing here in the United States and to balance the trade deficit. It's wonderful. As a matter of fact, the middle class has been so decimated that the top 1% of earners are now have more wealth than the entire bracket between 20% and 80% of earners. So that's the first time in history. So the middle class has been absolutely wiped out. Mm-hmm. So it's very noble of him to do it. And he came out with this Liberation Day plan, and he was a nice chart that he had. You don't see that chart anymore. but actually came with a formula of how he calculated that. I think he divided the trade deficit by the total amount of trade and then divided that number by 2 because we're a great loving nation. But at least there was some kind of surety, some kind of planning that could go along with corporations. They know the tariff rate. They know it was rather onerous. They could start making plans. Nike could say, do I really want to bring manufacturing back from Vietnam into the United States? Because the tariffs in Vietnam were, I think, 42%. But I want to say that a Vietnam factory worker makes $3,000 a year, whereas a U.S. worker makes $35,000 a year. So you need more than 40% tariffs to pay for that. But anyway, but now you have to stay tuned to every little tweet because there's, tariffs on China are 145%. Oh, wait a second. No, they're not. We're gonna go back to 20% tariffs on China. That's a huge difference. How do you plan? How do you make a plan to move a factory when you have all these carve outs and exclusions like electronics and iPhones and computers and chips? And who knows what's going to happen tomorrow, because tariffs are supposed to go up on pharmaceuticals, but maybe they won't remain once the pharmaceutical companies take a dive. So there's no planning that can happen. But financially, because of my model, which looks at these credit spreads and financial conditions, among the level of the real Fed funds rate, the copper gold ratio, it's 20-point plan. I'm not making that up. This has been developed over decades to look at the salient components that you need to view to see the second derivative of inflation and where the economy is going in the context of growth and recession. So that doesn't change every second of the day based on a tweet, but it does it does change based on these individual machinations. So you don't have to look at everything. You don't have to analyze. You don't have to come up with, I want to know every single tariff on every single nation, the average duty on every single nation. You don't have to look at that on a daily basis. Just look how it's affecting the financial conditions, right? And then you'll know what's happening with the economy and markets.
Well, Michael, obviously a very big part of what's going on in the world right now, and some previous guests have pointed to lots of demand for gold coming from this as well, is this role of, let's say, war and geopolitical conflict. How much do you think that plays into the current demand for gold?
Well, I mean, it's definitely a factor. I mean, if China were to invade Taiwan, this is probably the best time for them to do. If they're thinking about it anyway, which I think they are, and they say they are, this would be the time to do it. Not when relations are great; they're already horrible. So, yeah, I mean, there's geopolitical conflagrations. I mean, Trump did say he was going to end the war between Ukraine and Russia on day one. That did not happen. I don't think peace is broken out in the Middle East. And you do have a China who's an enemy of not my enemy. I love the Chinese people. I just don't like the Chinese government, but it's an enemy of the United States government too. So yeah, that is a definite factor. I don't think it's the most salient factor, but it is definitely out there. I think the most salient factor is that the chaos and debacle in the bond market, coupled with real interest rates, which are still, I think there could be nominal rates heading back to zero and real interest rates going profoundly negative. That's the projection that I'm making. So simply because the Fed is incapable. They have proven incapable of providing a real interest rate for consumers and corporations without having the economy melt down and asset prices melt down. So that's what gold is presaging.
Michael, when we think about, let's say, the world of investable gold and gold equities, how do you yourself separate that? Like, do you start to look at the producers as they're outperforming, as they're throwing off free cash flow? Do you only look at, let's say, the physical versus ETF side? How do you separate out the world of gold?
So I look at gold in two different buckets. So one is the physical gold, and that is gold that I have purchased and I keep in my possession, and there's no third party involved. It's me and my ability to protect the gold that I have. There's no financial institution, government, or anything standing between me and gold. I say that everybody should have 5% of their net worth in physical gold. That's my suggestion. Beyond that, I toggle the balance between 0 and 20%. So you should have between 0 and 20% of what I call liquid paper gold. And that means you own gold. It's highly liquid. It's in an ETF. It's in the physical gold ETFs like IAU or AAAU or GLD. It's in mining stocks. And that I toggle between 0 and 20% based on what I think the direction of real interest rates is going to be.
Right.
But I call it paper gold because you don't really own it. So I had this conversation with somebody yesterday. I was being interviewed, and this lady asked me, do you think gold IRAs are physical gold? I said no. I said not at all, because if you buy gold, I think if you buy gold and it's not going to be paper or liquid, so gold IRAs are not really liquid, and physical gold is not really liquid, but it's real gold in your possession. But gold IRAs, suppose someone in the government doesn't like something you said. We could be heading in that direction, or they say you make too much money. In other words, there's no reason why, if you own gold because you don't trust the currency, you don't trust the government, that's why you own gold. Why would you let a government able to take your, to arbitrarily and capriciously remove that gold from you? They know you have it, you know where it is. They could say, okay, you no longer have that gold. That's been taken from you. Now, I understand that the government could take you away anytime they want to, but I'm just saying, why make it easier for them to remove your assets? Mm-hmm. You buy gold because you don't trust financial institutions. Why have your money in an IRA, in a gold IRA, which could go down with the ship with the financial institution that you placed it with? So that's how I think about gold. So there's physical gold that you hold, that you possess, you control, and nobody else is in the way of it. And then there's liquid paper gold, gold that you own that gives you exposure to a rising metal price, but you don't have physical possession of it, but it is liquid. You can sell it or buy it instantaneously.
Thinking about that piece of it more as a trading tool rather than the store of value or savings account, if you will.
One is an investment. The other is a legacy asset that you hand to your children and grandchildren. Mm-hmm. Totally different.
With totally different timelines and
totally different timelines.
Yes.
One you trade because real interest rates are going to rise and the economy is stable and everybody trusts the government, and I could put my money in the bank and get a real interest rate of 3-4%. And why would I hold my money in gold, which yields nothing? Because the currency is not falling. I trust the government. Everything's fine. There isn't any insolvency issues, and I want to make money on that. Then your toggling should be 0 with your liquid paper gold. Mm-hmm. You wouldn't sell your 5% gold. But when times when real interest rates are negative and you don't trust the solvency of the government and the dollar's getting destroyed and there's global conflagrations and there's risk of default and asset bubbles popping and there's no competition from bonds and stocks, and you would toggle that closer to 20. Mm-hmm. We're at a little bit above 10, I believe, right now, about 10%.
Mm-hmm. Michael, going back to this idea of let's say the gold miners, do you ever see a scenario where institutions and larger larger funds start to see this outperformance of, let's say, the miners versus the stock market, and they start to rotate into this sector as well?
Well, gold miners tend to just amplify the return on physical gold. So if gold's going to go down, the miners will do a lot worse, and if gold's going up, they'll do a lot better. So, having said that, miners are also stocks. So when the stock market hits a pothole, they sometimes can suffer too. So they are a part of my liquid paper gold investment, but they're not a major portion of it. Mm-hmm. But when gold is in a primary secular bull market, you should have some exposure. I have the royalty companies in my possession.
Because of the, let's say, cost that it takes to run a company like that?
Exactly.
Are there any other metals that you have exposure to? Like
zero.
Okay.
Because gold isn't a metal. I mean, I know its chemical symbol is AU, and I know it's an element, but it's money. Gold is, and not my opinion, not your opinion, it's a fact. It's been money for thousands of years. Mm-hmm. It's virtually indestructible, very beautiful, and very, very rare. There's really they're not creating any more of it. It's harder and harder to mine out of the ground, more and more costly to do so. It's not going to be replaced by Bitcoin. Bitcoin is not gold 2.0. Bitcoin and cryptocurrencies are a function of liquidity. When liquidity drains in the system and stocks go down, you see the same. You see, Bitcoin and cryptocurrencies go down. It's the opposite with gold. Gold is real, honest money, and it always will be, in my opinion. So there is no comparison.
Mm-hmm. But does silver fit any of those categories as well?
Silver has got precious metal and base metal components to it. So it's poor man's gold, and I'm not a poor man, and I don't want to be one. So I'm going to stick with gold in times of crisis as opposed to silver. In times of global reflation and stability, you might look to silver because of its industrial component, but gold and silver are not the same. As you know.
Yeah. Excellent, Michael. Well, I really appreciate you walking us through all of these different ideas and, giving us a peek at your model. I know that, you and I were saying before we hit record here this morning that it has been already an exhausting 2025, a million things to try to
exhausting,
take into account. Yeah, I remember the first Trump presidency and just being exhausted by the news cycle. But, having a model like yours to be able to step back and detach from this day-to-day up and down and back and forth, I think is extremely valuable. And
it's not only, thank you for saying that. It's not only valuable, it's imperative. It's mm-hmm. essential. Because how would you manage money? Unless you're of the ilk that says we don't really actively manage, we just think the market's always going to go up, and even if it goes down, it will come back. That's what 95% of people will tell you. I just don't think that's a good enough answer. If you're getting paid to manage money, then manage it. Mm-hmm. Don't just sit there and say it's going to come back, because then you're not managing money. You're getting paid for doing nothing.
Mm-hmm. Excellent, Michael. Well, I appreciate, again, you walking us through all of these things today. For anybody that wants to see more of your work, that's all available at pentoport.com, and of course on Twitter as well, at Michael Pento. Michael, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.